Understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
We have no exposure to Evergrande, is the short answer. Our own strategy on China for the last several years has been built on building independent credit decisions and credit underwriting.
Coming up to 26 minutes into the session, this is your bounce back, up 0.7% on the S&P, on a Russell up 0.5% on the Nasdaq, up 0.9. That's the turnaround this Tuesday. Here's your trading diary. Coming up through the day ahead, President Biden delivering remarks on the bipartisan infrastructure bill this afternoon. Ton of Fed speak with Mester and Williams on deck. Tomorrow, the ADP report, initial jobless claims on Thursday, and then we round out the week with payrolls Friday. 488 is your estimate. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Impact China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman.
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 10 a.m. in New York. It's 3 p.m. in London, 30 minutes into the trading day right here in the U.S. From New York, I'm Alex Steele. My co-host, Guy Johnson, will join us later on in the hour. Welcome to Bloomberg Markets. And we have an amazing show, a very special show lined up for you. Both Guy and I are participating in the Bloomberg Invest Global Conference. So coming up in just a few minutes, Guy's going to be speaking with Luke Ellis, Man Group CEO, and I'll be talking to Jonathan Gray around 10:40, Blackstone President and COO. You can't get two better market voices than that. And there are a lot of questions happening right now within the market. Yes, we're getting a nice rebound here, particularly in the New York FANG stocks, which sort of bounced off their 200-day moving average. If you take a look at the board, as well as the S&P moving higher, a large part of that, though, is still energy on that continued upswing as Brent hits 82. I think the question, though, is how long can some of this last? A little bit unsettled here with Elizabeth Warren going to speak on the floor about Federal Reserve at 11 o'clock today. That could be a market event. Infrastructure, still a market event. We have Facebook and the testimony on the Hill. That could be a market event. So there's still a lot of uncertainty that we're watching. Plus, you do have some selling in the bond market. We're now pushing higher in yields, 152. What's the level? What's the level where investors get nervous? A lot to digest over the next couple hours. In addition, we have ISM Services Index coming out for September, really strong. 61.9. Very, very strong, even better sequentially than where we were back in August. Want to dig into all the details here, prices as well as demand. Joining me now is Anthony Nieves, ISM Services Business Committee Chair. Anthony, how is ISM Services doing so well? What's your read here?
Well, that's a great question, and we've been doing very well since we see businesses reopening from the pandemic. We had all-time highs back in July, a little bit of pullback last month, but when we look at the 61.9, it's up 0.2 percentage points, and it's really reflecting strong growth across almost all of the industries that comprise this sector.
So before we get on to pricing real quick, I thought that Delta was supposed to change this kind of reopening narrative. Did it not?
Well, when you look at it, we've had this pent-up demand. And right now we're experiencing some capacity constraint, or else we might even see stronger numbers.
So capacity constraints, which then leads us to pricing. And I wonder kind of where we're sitting in terms of prices and what you notice there.
Well, we hit some all-time highs back in July, which is typical when you see an economy come back strong. We see some inflation creep in, but we have right now is demand is exceeding supply. We have supply chain disruptions. And with all this pent-up demand that's being released, and even with the consumer confidence waning slightly, it's still strong in the sense of people are paying for the products and the services that they're looking for.
If we hit an all-time high earlier, does that mean that the services inflation that we have seen is transitory, or do we expect prices to increase, say, in the fall?
Another great question. Transitory, we thought so, but from what our respondents are telling us now, initially they thought that we would see some relief from pricing probably in the first quarter, second quarter of 2022, but they're projecting it to be even further now due to some of the disruption we're experiencing. And I think we'll get a better picture on that when ISM comes out with their semi-annual forecast in December.
Why haven't we noticed the demand destruction?
Well, I think that when we look at everything that's been reopening, and the fact remains that some of these businesses, especially in the customer-facing businesses, they are experiencing labor shortages. And so they're not even at full capacity at this current point in time. So I think that with everyone wanting to partake and go out and buy things and frequent restaurants and dining and hotels and whatnot, we're seeing that they're just not at the level that is necessary for us to really have full capacity at this point in time.
Do we have a sense of sort of what's going to bring more people back?
Well, I look at it as right now, people that were in, say, lower level, not as much in the skilled area for, say, the hospitality industry or some of the retail positions, they're moving into other types of businesses or not going back to work at all. And so that's why we're seeing difficulty with the backfill on the employment side.
Oh, that's interesting. So then I wonder when it comes to, say, deliveries, inventories, one of the things that we're expecting is that inventories are going to have to rebuild once the supply chain clears a little bit, which will then maybe push growth out a little bit in 2022. What are you guys noticing?
Well, when we look at the inventory index at 46.1, it's been contracting for the last 4 months. And the challenge is that the various companies within these industries cannot build up their inventories fast enough. They can't replenish fast enough. And we're seeing that as it correlates to the backlog of orders as well as the slowing of deliveries that's been ongoing.
Then what does that mean then for the order backlog? Order backlog and then new orders?
Well, new orders, as it reflects what's in the pipeline, and we're seeing strong numbers there at 63.5. So again, we have the demand exceeding the supply. We've experienced material shortages very similar to what you're seeing on the manufacturing side, keeping in mind many of the manufacturers are providers and suppliers to the services sector. So what we're seeing in the supply chain upstream is with the material shortages, it is impacting the ability to get the goods and services on the services sector.
Really great stuff. Super appreciate it. Thank you so much for joining us, Anthony Nieves of ISM. You're looking at 61.9. That was the number that we got from ISM Services. And you still have the equities right around the highs of the session. S&P up 0.8%. Coming up, Luke Ellis, Man Group CEO, joins Guy Johnson of the Bloomberg Invest Global to talk all things markets. Great market force for you right here, just 40 minutes into the opening of trade. This is Bloomberg.
第18条第2項により本院において内閣総理大臣に指名することにこの際暫時休憩いたします。
A lot's happening on Wall Street.
It's the basic law of economics.
Is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
As promised, let's get right to the Bloomberg Invest Global event, which is happening right now. My co-host Guy Johnson sitting down with Luke Ellis, Man Group CEO. They're talking about equities and how to manage risk.
Hate their bonds right now. What do we do about that? If government bonds are going to be problematic for quite some time, and it looks as if we're going to find ourselves in a situation where potentially yields are below inflation, negative real rates for quite some time, what's the alternative? What else do you do in a portfolio to provide that kind of counterweight without being in govies?
Well, I think this is where hedge funds should come into their own. Look, there are a number of things which you can look at, but at heart, what you've described is this problem that government bonds, they don't provide a stable store of value, particularly if you're worried about inflation, and they don't give you any income. I mean, literally none in many countries. And so they don't really fulfill a function in a portfolio, the stabilizer or the income, or they're not really doing something useful. And so I think you have to look at bonds really as a trading instrument. there are opportunities to make some very good money out of some of the rallies and also some of the sell-offs that, and maybe we'll get more sell-offs and there'll be an opportunity to make money out of being short. But just sitting long bonds feels like the wrong answer. And so either you've got to find active credit strategies, which at least can give you some carry and an opportunity to get in and out of interesting names as we get developments on the growth side, or you're looking at alternatives. And this is, at heart where the basic hedge fund industry came from, is an alternative to long bonds. And, I think the hedge fund industry has done a good job in the last 18 months of showing that, can ride through the storms and deliver, it's not miraculous returns, but it's solid, steady returns, which compared to bonds looks pretty attractive.
So what does that look like in terms of constructing that? As you say, there's a whole sort of series of alternatives that come in. I'm sure some of it's public markets, I'm sure some of it's private markets, but just give a kind of an idea of what that option looks like. If you don't want to be long government bonds, if you want something that looks that provides a similar objective or has a similar objective to that, what does it actually look like? You talked about the sort of the credit portfolios, but kind of walk me through, if I was a client and I came to you asking this question, what would we be talking about?
Sure. Well, so I think the first thing is to exclude all the things which are effectively long economic growth, because that's what you get from equities. So you can choose private equity relative to public equity. You can debate which gives you better value at any one point, but they are essentially the same risk. So, when people move to private markets, it's for the hope of a pickup in yield. But, while you might get a dampening in mark to market in private equities relative to public equities, it's the same risk, right? It's long growth. And also some of the sort of lend and hold strategies are also, again, really about being long growth. So you're looking for the things which are not that, right? So you're looking for market neutral type of strategies. You're looking for diversified strategies. And we think there's a lot of things with the volatility you've got in markets, it's making them more inefficient. That's creating some nice margin for people, playing on efficiency. There's good stock picking returns and credit picking returns to be had. You just have to be careful of sitting long something and holding it forever. So, there's no point going into a hedge fund strategy that's 60% net long equities all the time, because that is correlated to equities by definition. You're looking at the stuff that's not correlated to equities, and that's the starting point, because that's what you were aiming for from your bond portfolio.
That's an incredibly small group, though, isn't it, at the moment?
Two or 3% real returns out of their bonds and hoping for more than that out of equities. Clearly it's a struggle to get anywhere near that. So that's where hedge funds come in. And it's also where a number of the sort of the income type strategies in private markets come in, where you can get a number of things with long-term inflation protected cash flows. And those are also very attractive to people when they recognize what they were looking for from the bonds.
Let's back up a little bit and talk about some of the other things you raised at the beginning. The volatility that we're seeing at the moment, do you think that we are heading into a higher volatility environment? I think the average on the VIX going back to, it's just one metric, of course, and there are plenty of others, but I think the average on the VIX is something like 19 going back to the beginning of the 1990s. I think we're trading sort of circa 22, 23 at the moment. Where do you see the story going from here? Are we entering a more volatile period? Clearly, we've had volatility suppressed by central banks, but I'm wondering whether or not, as central banks look to exit current monetary policy, whether or not we do see volatility pick up, and if so, where are the opportunities there?
Yeah, I think that's very good way of thinking about the problem. And what you did, which is important, is to look at the VIX all the way back to 1990. People have a tendency to think about the last 10 years until COVID and think that was a normal environment. And the reality is, equity volatility was very low during that sort of 10-year period post the financial crisis before COVID. Why was it low? Because you're right, that the central banks had dampening policies, but actually, more importantly, every central bank was following essentially the same policy. Every government was following essentially the same policy. And so you had real lack of volatility in economic outcomes. You had a very monothematic market. And so it was a very low vol period. I think that has broken firmly. You can sort of question whether it was COVID that broke it, or maybe it was a bit earlier with some of the economic policies that government started to follow. But, as we've gone from what's been a pure monetary world where, sort of central banks were controlling governments into a fiscal world with central banks essentially being the tail on the dog from governments, then you naturally get a lot more volatility in economic outcome, and that creates more volatility in markets. Generally, it creates more volatility in stocks because, government policy is starting to interfere with stocks a lot more. That creates opportunity, that creates stock picking opportunities, good and bad, right? I mean, I think that's one of the things is you can see winners out of some of the changes in government policy at the moment. It's very easy to see losers in a number of things. And so, it's where a long short type of thing helps. But if not, if you're long only, you just need to know what to avoid so that, a change in government.
Let's talk about government policy. It's interesting we have a hearing on the Hill today talking about Facebook. It's going to be interesting to see what regulatory changes come about as a result of that. But the biggest kind of obvious, most clearly defined interference by government in markets has been in China. What do you make of what we're seeing there? Does it change your attitude towards China? China's very hard to avoid if you are simply investing in indexes, but what is your attitude as a hedge fund towards how the situation is changing?
Look, I think if you are investing in markets, it's impossible to have no view about China. It is too big a portion of the markets out there. It's too big a portion of the global economy to ignore. So you have to have a view. And I think the bit in China is to work out where there are financial opportunities and where they are going to be curtailed by government policy. In China, they tend to be more explicit. I think, we went through a period in the West of deregulation for 20 years, 30 years. I don't know, it was a sort of a long train of increased deregulation. Increased regulation started coming to financial markets after the financial crisis and has been coming to a lot of different sectors and more in the West. So what China is doing is quite explicit, but it's not that different than what we see in a lot of the Western markets. So I think what it means is you have to be lighter on your feet. You holding something with a 10-year view really doesn't make sense in a world where you get these interventions, where you get significant changes in policy. And so, I think what it requires you is always to have, let's put it this way, we would always say have liquidity in your positions. If you don't have liquidity in your positions, then you need to get a significant premium for the fact that the tail risk from interventions is significant. And, we've seen some of those numbers in China being really quite significant. Our view is it carries on. The Xi Jinping, one of the things is he changed rules so that he can be re-elected for longer and longer periods. But he hasn't yet been elected for the next period that's coming up in sort of the next year. And so it's really important for him that, he has the party on his side for that process. Who knows exactly how it happens within the Chinese Communist Party, but there is a process. Yep. And, it's important to him that he comes out on top of that process.
As that process unfolds, is China investable, or are the risks, because they are quite hard to define, make it significantly less attractive?
I think it definitely makes it less attractive than it was a year ago. You can see, the trends which people were taking advantage of, the big winners in the tech space and some other spaces, those have been broken. And so now you have to invest in the knowledge of, this sort of shared prosperity idea that they have in China and how that's going to affect things. And, you need to make sure that the things you invest in are on board with the government, sort of the zeitgeist of what they're trying to achieve. That creates some opportunities, and it definitely creates some shorts where there are many companies which the market hasn't yet worked out are really not pulling the way the government wants them to pull.
Luke, you've painted a picture of needing to be nimble in a number of different asset classes, in a number of different geographies. Do you think most large funds, though, are built for this? I appreciate this is something that you would try and certainly help them with, but most supertanker-sized funds move very slowly. How do you think they're going to perform in this kind of world?
Yeah, I think that is very important. When you look at the large end investors, the large pension plans, even the sovereign wealth funds in the world, they tend to have very slow-moving asset allocation processes. And that is natural because of the bureaucratic nature of their trustee boards and the organization structures. They're all slightly different, but they end up with fixed strategic asset allocation, a tactical asset allocation that allows a little bit of freedom, maybe then some sort of adjustments the CIO can make, but they're all at the margin. And, the strategic asset allocation takes a long time. So we're certainly having a lot of conversations with sophisticated large plans who recognize in this world looking forward as opposed to the one looking backwards, that starts to feel uncomfortable. And they're looking for ideas of how someone can help them to manage those risks without wanting to, you're not going to take $100 billion pension plan and suddenly swing the exposure around week to week, but you can over time make significant differences and make a significant improvement to the overall return. They all have a rebalancing process. Sorry, go on.
How much? One of the things they are certainly trying to do is green their portfolios. ESG is obviously a huge part of the narrative right now. In terms of how that, again, fits with what you're talking about, these large funds are very slow moving, but they need to make this transition. We're moving into a world which looks a little bit more volatile, and we're still trying to understand what exactly is green and what isn't green. How much of what you are doing right now and the conversations you're having have to have that part of that conversation, have to have, even in a world where inflation is focusing people's minds onto the energy sector, has to be part of the narrative that you're talking about? And how does a hedge fund and ESG work hand in hand?
So this is, I think we've passed in the ESG front the place where most clients, you have to have ESG involved in the conversation. Right? We're past the point where you could say, oh, can I talk to you about ESG? And they go, oh, that's new. Now, everybody understands this. People have different views about how it applies. Right? I was talking to one public fund in the US who was talking to the CIO about how they came up with a plan, because there are local politics to deal with who, have particular views about how they should react. But at the same time, you are saving, for the long-term savings of teachers, firemen, whatever, even journalists, broadcasters. It's long-term savings. If you're saving for people for 20, 30 years, which is sort of the timeline the average pension fund is looking at, they have to think about what the world will look like when you actually pay off the savings. There's no point having a load of money if the world that you've saved into, actually the money doesn't help because you're not able to live where you want to live because the temperature changes happen so much. Yep. So clients are expecting inclusion of ESG. I think we're now moving to the next phase where they're asking, okay, what can you do with a portfolio that will actually help reduce the climate change that we're all worried about in the world, will reduce the warming in the world? And so that is, we're moving, I think, rapidly to the next stage where clients want portfolios to have a positive impact over a long-term timescale for how do I actually help fund a world that stays below 1.5 degrees of warming. Yep.
Well, it's certainly going to be a big focus as we approach COP That is certainly going to be the story over the next few months. Luke, it's always a great pleasure to spend some time with you. Thank you very much for sharing so much of it with us today. Man Group's Luke Ellis.
It's a pleasure. Thank you.
You've been listening to Luke Ellis, Man Group CEO, speaking to Bloomberg's Guy Johnson. This is day one of Bloomberg Invest Global, and you can continue to watch it on your terminal at LiveGo and on the Bloomberg website. And stay with us right here on Bloomberg Television, because coming up in just about 15 minutes' time, I'll be speaking with John Gray, Blackstone President and CEO. Definitely don't miss that. It's going to be a really fun conversation. In the meantime, let's get a quick check in here on the markets. I don't even really want to call it a turnaround Tuesday, to be honest. Yes, we are up 1.6% for the FANG stocks. Yes, we're up 1% for the S&P. Energy also outperforming within the S&P, but it still feels like we're really unsettled here. We're still trying to work out the reflation, inflation, stagflation kind of scenario, and there's a lot of risk factors on the market. What happens to Facebook today on the whistleblower hearings? We have Elizabeth Warren speaking on the floor about Powell and the Fed coming up at 11. Is there a real risk now? The Fed Chair Jay Powell won't be head of the Fed, and what will that mean then for the bond market? We also have earnings season kicking off next week as well. You're not seeing any safe haven bid anywhere. Money coming into the commodity market and some selling happening in the 10-year yield up 5 basis points, but there's still many question marks. This is Bloomberg.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back. Let's focus on Facebook. A double thumbs down for the firm. This, as the social media company suffered the devastating outage that many of us experienced yesterday. Basically, it shut out many of its 2.7 billion global users yesterday, which confused a lot of people, I have to say. Meanwhile, Facebook whistleblower Frances Haugen is testifying right now, as you can see, before the Senate subcommittee. Haugen is claiming the company is aware of how its platforms are used to spread hate, violence, misinformation, etc., etc. Facebook, of course, denying those claims. Let's figure out what's going to happen here. Joining us now, Bloomberg tech reporter Anna Edgerton. Anna, where could this go? This is obviously a kind of bombshell moment in terms of the narrative surrounding Facebook, surrounding social media. There has been momentum towards changing a whole series of regulations surrounding this sector. How big a catalyst will today be?
Yeah, that's exactly right. You know, we understand pretty well the allegations that the whistleblower has already made. They were reported by the Wall Street Journal, and now we've seen all of those documents that she brought from her time in Facebook. So what we're looking for now is exactly how Congress will respond, and there's two things that I'm looking for. One, what kind of legislation they could pass to increase regulations on the tech industry, and also where this investigation goes from here, if the Senate Commerce Committee will use its subpoena power to compel Facebook to release more documents and call more executives in to testify.
Anna, we'll continue to cover what is happening. Thank you very much indeed. If you want to carry on watching this, you can do so. You can find the hearing. It's on your Bloomberg terminal. Live Go is where you'll find it on the Bloomberg. Let's switch to another part of what is happening in Washington. President Biden's sweeping economic agenda, as we all know now, faces an uncertain future in Congress. This after he failed this week to unify his own party around a strategy to pass bitterly contested infrastructure legislation. It's a huge priority for him. Let's go to D.C. again. Bloomberg's Washington correspondent Anne-Marie Hordern on Capitol Hill. Anna, the president, the party leadership, juggling a whole range of issues right now, from what is happening in terms of the two infrastructure bills, human and physical, and also trying to manage exactly what is going to happen surrounding the debt ceiling to ensure the bills get paid. Where are we?
Yeah, it's a good point, Guy. They're really racking up the struggles right now facing the party. Let's start with the debt ceiling first, because that is the first and foremost. We're going to hit that X date that Treasury Secretary Janet Yellen had outlined very soon, 13 days, October 18th. Now, if the Democrats were to go it alone and go via the situation of reconciliation, where they would not need a single Republican vote to suspend or lift the debt ceiling, experts say they should have started yesterday, which is why you can see this is starting to be a little bit more of a worrisome issue for the party. But at the moment, both parties are still digging in their heels. The Democrats say that the Republicans should do this in a bipartisan fashion, and they point to what happened under the Trump administration. 3 prior times dealing with the debt ceiling was done with bipartisan support. But the Republicans say they are going off on their own for this $3.5 trillion plan, which the Republicans are not on board for. And because of that, they don't want to sign up for helping them with this debt ceiling. They want to make it a little bit more labor intensive for them. And then when you look at infrastructure, Guy, what we do know is that there has been a little bit of progress on the soft infrastructure package. The president yesterday, meeting with progressive leaders in a virtual meeting, said what we've learned is that they talked about what that top line figure would be. And that would be around $1.9 to $2.2 trillion. So likely this could be the potential sweet spot for those two key senators further from the party, Senator Joe Manchin and Kyrsten Sinema. So a little bit of progress on that front.
Yeah, I think Joe Manchin's on CNN right now talking about that kind of number, 1.9 to 2.2. Anne-Marie, you talk to a lot of people down there in D.C. What are they telling you about the likelihood of a default actually happening? Clearly, we've seen the threats from the Treasury Secretary, from the Fed chair. There's obviously concern growing around all of this. But nevertheless, the market seems to be firmly believing that actually something will get sorted out. Are those that you talk to there as confident?
The thing in Washington, Guy, is that it's almost, I don't want to say it's an inside joke, because it's not. It could be catastrophic for the U.S. financial markets, for the global financial markets, for people's jobs and livelihoods. But there is this sense in Washington that this debate happens all the time. It's happened 3 times during the prior administration. It always comes up. Presidents give speeches about it. And that is just complete political posturing. And at some point, someone will blink, because no one wants to be responsible for the U.S. defaulting on their debt. What was very interesting about the president's speech yesterday, which I attended, was the final comment he made when he was asked, would you rather not go through reconciliation, or can you guarantee that the U.S. would not default on its debt? He said, no, I can't not guarantee that, and it's up to Senator Mitch McConnell. So you could see the political posturing, but at that moment he said he could not guarantee it. Does that put into question the financial fiscal health of the U.S.? Is it ironclad anymore? Many people might be asking that, but no one here actually thinks we would come to that point. But we are getting close to that date, so it does become a little bit worrisome if someone at some point is going to just have to blink.
AMH, great stuff. Thank you very much indeed. Bloomberg's Emery Hordern joining us from D.C. Remember that we do have Elizabeth Warren coming up at the top of the next hour. She's going to be talking about the Fed. I think David Weston is talking to her a little bit later on as well. So a firm focus on what is happening with Fed succession and ultimately whether or not we are going to see a change. Let's talk about the data. ISM services coming in at the top of the last hour. Alex broke it for you. A little stronger than estimates. What impact is that having on the markets? Let's find out. Over to you, Abigail Doolittle.
Well, Guy, it's having a bullish impact on markets because that ISM services for the month of September coming in at 61.9 versus the estimate of a little bit below 60 versus the last month at 61.7. So we can see here in the S&P 500 E-mini futures a big spike up overnight, basically flat, small gains, and then on that bullish number. Because let's remember, we have this Delta variant not so long ago. Folks were worried that people were going to stop dining out and traveling. This is services. That is the area most affected potentially if people were to stop those activities. But this index right now for the month of September suggesting that Americans are confident enough to go out there and travel and dine. Now, if we break it down and take a look at some of the best stocks on the day, yesterday we had that tech wreck. Today we have a bit of a bounce back. Not as much for Apple, but nonetheless we do have a gain for Apple, up 0.5%. But you can see nice gains for Microsoft, Facebook coming back to some degree from its big sell-off yesterday. And then, of course, Amazon also higher, up 1.5%. This despite the fact that we have yields rising because, of course, on that bullish print for the ISM guy, bonds started to sell off. That tells you yields go higher. If we take a look at an intraday chart of the 10-year yield, it's not as dramatic as the spike up for futures, but you can see actually it started prior to that print coming out. But the overall spike up does look pretty dramatic. You can see a backup of 5 basis points on the day. So that 10-year yield now at 1.53%. The point is big tech is okay with this level of yields right now. Will that be the case if it continues going? We don't know that, of course, Guy, but it's an interesting dynamic to see as some days yields go up and big tech looks past it, other days not so much. Today happens to be one of the days that we're looking past it. The S&P 500 right now on pace for its best day since July.
Abigail, great stuff. Doesn't always line up, does it? Abigail Doolittle on what's happening in the markets. So what do we got coming up for you? Jonathan Gray, Blackstone President and COO. He's going to be talking to Alex in the next few minutes. We'll be back at the Bloomberg Invest global event that we've been tracking. I was just talking to Mr. Ellis. Should be talking to Mr. Gray. That conversation in a few minutes' time. We've also got some market moves that are probably worth focusing on as well. The German 30-year rising 3 basis points. Spot 29.30. That's the highest since July. This is Bloomberg.
At the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think that at $80 per barrel, maybe some of them with less cautious will restart somewhere else, and then you could see again. But all that is a little delay. So we have entered into, I would say, a cycle of high prices.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So in a moment, we're going to be back to the Bloomberg Invest Global Summit that's taking place. Alex is joined now by the Blackstone President and Chief Operating Officer, Jonathan Gray. Let's listen to this conversation.
Real conversation before this. I actually want to pick up on what somebody said earlier in the sessions, that Bruce Flatt said that now is a good time to be liquidating assets. What do you think about that?
Well, I think for stabilized assets, markets around the world have been pretty strong. So obviously rates are low. There's a lot of liquidity. So we have, like others, been selling assets. But I don't think you're necessarily saying this is the top of a market. But I do agree that generally it's a good time. Markets are liquid, so exiting makes sense.
Is that different, though, than calling a top?
I think so. I mean, look, we're at an interesting transition point. Everybody's starting to focus on inflation, and with inflation and the Fed getting close to tapering to, buying less bonds, long rates may very well go up, and that can put pressure on asset prices. And so people are looking at that and trying to position themselves. But on the flip side, the U.S. economy and the global economy is pretty good. So I'm not certain. I wouldn't say, hey, I want to take a really defensive posture. I just think you want to be thoughtful about the types of assets you invest in, the types of assets you hold.
So let's get to it.
Yes.
What are they?
Well, I would say a couple things. I think the biggest thing is in this kind of environment where rates are likely to go up on the back of higher inflation, what you don't want to own is long duration fixed income, because there you're more vulnerable. There's no place to hide. What you want to try to own are businesses and assets that can grow. And even if multiples come down, value can increase because of the growth in cash flows. And so for us at Blackstone, we've really tried to be thematic investors. Look at some of these huge changes that are going on around the global economy and how can we benefit from them. They would be things like the movement of everything we do online. So shopping, paying for things, entertainment, healthcare, education, all of that. So we've invested in businesses like Bumble and Ancestry, but we've also invested in businesses that are one derivative off: digital infrastructure, data centers, fiber to the home. We've been the biggest investor in the world in last mile logistics, warehouses, based on that e-commerce boom that's underway.
But you guys were already doing that before the pandemic.
We were doing that before the pandemic, but if you look at these trends, look at e-commerce, it's gone from 0 to 20%. It's probably going to go from 20 to 40%. I'd say the same thing about life sciences. That's been accelerated by the pandemic as well. But big data, genomics coming together, mRNA, immune therapies, all of this. So invest, sort of beaker to bedside. Invest in the buildings themselves. Invest in companies running trials. Invest in promising therapies. How can you take advantage of what's happening in a market? I'd say this about green energy as well, wind and water and solar and all the infrastructure that goes with it. And then I would say some of these big thematic areas are not necessarily technology driven. Could be global travel, rising middle class in places like India, alternatives, housing. We've had a real shortage since the financial crisis. And so as investors, when we think about deploying capital, we say big picture, where are some of these really attractive, good neighborhoods we like? And then how do we flood the zone there? How do we express that in a bunch of different asset classes?
So I have to think, though, that a lot of people are going to try and flood those zones. And just today, JP Morgan Asset Management said, look, we can have higher rates, but real rates still stay low. You need to go into alternative assets. You need to go take on a little bit more risk to get that yield. I mean, there got to be a lot more people invading your space.
So alternatives definitely are coming of age. There's no question of that. But their scale is still pretty small. So today our industry's, I don't know, $7.5 or $8 trillion, which sounds big, but stocks and bonds are $250 trillion. And what we see investors doing is not necessarily taking more risk, but they're trading some level of liquidity for what they believe will be higher returns. And the data looking backwards has shown that. And so in our business, if you look back a decade ago, we were basically in private equity, real estate private equity, distressed credit. That has broadened pretty dramatically over time as we move into things like core plus real estate, infrastructure, direct lending, structured credit. And the people we can serve, the pools of capital have broadened beyond just traditional pension funds, now to insurance companies and individual investors. And the types of assets we can buy have broadened a lot. And we've compared this to basically a ship that was operating in a very narrow channel, moving into much more open waters. And that means for our industry and our firm as the leader in this industry, it bodes pretty well. And so we're very optimistic.
But as you have rates go higher, does something like direct lending get riskier?
Well, direct lending tends to be floating rate. So we're lending to companies that are non-investment grade. They're often in transition, so they're borrowing floating rate. I think the risk in a higher, certainly the risk in a higher rate environment is long duration fixed income. So being a direct lender, we have a non-traded BDC that serves individual investors. It lends to companies on a floating rate basis. So if the Fed, in response to inflation, starts to raise rates, that's obviously beneficial to this kind of product.
Meaning that you don't think there's going to be a default?
Well, not necessarily default, meaning the return goes up.
Sure, but underlying company, they're not going to see a default cycle like we might have seen otherwise.
Yeah, I think the risk of the environment we face today is not an economic slowdown. It's a bit of overheating. As we come out of this COVID hibernation, I think the risk is we see real economic strength. That's what we're seeing. Virtually all of our portfolio companies are seeing revenue growth. We're seeing very little in the way of defaults out there, record volumes at ports. We're seeing strength in housing. So broad-based economic strength. The risk is that rates move higher. So if you lend to companies and their credit worthiness is improving, but you get paid more because you get paid, say, 400 over, and the base rates move from 25 basis points to 125 basis points, you're earning more as that lender. So if people need exposure to fixed income, I think you want to err towards floating rate securities.
So that would imply also that the companies have the earnings and the growth to match whatever payments, et cetera, which means that it doesn't seem like then you expect a stagflation scenario, more of an inflationary one.
I would say in the near term, no. I would say when you look at all the savings that have been built up, you look at various elements of the economy, you look at the fact that there's sort of this global cabin fever you and I were talking about getting out there. I think we're going to see strong numbers, revenue numbers from most companies. The risk is input costs, certainly financing costs, but now wages, commodities, rental housing costs. That's the risk to companies' earnings, that their input costs go up. I think their revenues will be pretty good. And I think we've got some runway here in terms of revenue and economic growth globally for the next couple of years as we come out of this. At some point, we'll probably revert again to a lower growth society around the world. But near term, I'm more worried about an overheating. And I think that will put additional pressure on the Fed and other central banks potentially to move a little sooner than people may have thought 3 or 6 months ago.
Yeah, speaking of, I haven't eaten indoors yet. I refuse to eat indoors in a restaurant yet. I know it's crazy and weird. Do you think then the Fed could be on a policy mistake?
No, I think, look, the Fed has a very challenging position because there are still parts of the global economy, the U.S. economy, that are weak. In these cities, people haven't come back. We have supply chain challenges. There are certain industries that remain under pressure. And so they're trying to run a fine line. I think the risk for them is, as inflation spreads and becomes more pervasive, do they need to course correct? And I think there's a potential they have to do that. I'm happy I have my job, they have their job, but our overall expectation is one of pretty good economic growth, but higher rates, higher inflation, and again, try to buy and invest in companies and businesses that can do well in that environment.
Let me pick your brain on China for a second. Amy from HSBC Hong Kong sent in a question. And one of the questions was, can we buy the China market in the dip right now?
You know, we're not as much public market, should I buy stocks or not? But I would say extrapolate. What I would say is long term, China will continue to grow faster than most of the developed markets. They've got a very entrepreneurial culture. They've got a government that wants economic growth to improve quality of lives. And so I think that means, broadly speaking, China should do well. Now, I would note, of course, as we've seen over the last 6 months, that there are industries and sectors that are more sensitive. So if you think about education, you think about healthcare, you think about housing, things that impact lower and middle income Chinese people, those are areas you have to be more selective. The same thing around some of the businesses that have a lot of consumer data. But broadly speaking, as China has traded off, I think it could create some interesting opportunities.
How do you find them? Where's the spot when everything seems to be maybe at risk from government oversight? Well,
there are plenty of companies that are in different businesses that could be consumer facing in, say, restaurants or leisure activities. We've been investing in real estate in China, warehouses, office buildings. Again,
is there contagion there from Evergrande, or is the Evergrande thing just totally a housing property thing?
I think it's much more housing focused because that's where the big development companies have the mismatch. And there, I would say, in terms of contagion, I would think about it more as something that will impact institutional global investors in the high yield market. Domestically, I think they'll protect their local banks. They'll protect the individual homeowners. So I think it will have a knock-on effect. Those companies will have a higher cost of capital. They'll probably slow their development pace. But I don't see that spreading to something that's systemic within China.
What about outside of China? I mean, has the turbulence there created some opportunities for you guys elsewhere in other countries?
You know, I think markets, when they trade off and we're looking to deploy capital, that's helpful. One, it reduces asset prices, but two, it reminds sellers that asset prices don't keep going up. And so
we forgot that.
Yeah, you forget that for time when you get lulled into a sense prices go up every day. And so, you know, that can motivate a seller who could own real estate or infrastructure or a tech company or somebody to say, hey, look, I want to sell a piece of my business. And so for us, we're focused long term on delivering for our customers, delivering outstanding returns. And so when markets sell off at times, because we have long term capital, we can move into dislocations, deploy capital, and then over time, when markets are more receptive, think about exiting. And so we look at it and say, if there's a particular market that's fallen out of favor, that's something that could create opportunity.
Is there one right now geographically?
Well, I think the UK has been pretty interesting for a while. That was a place where Brexit and then COVID created some opportunity. We've been very active there. Certainly, we talked about China could create some opportunities because in the tech sector, there's been, and broadly, you know, foreign investors have become more cautious. You know, I think interest rate sensitive sectors could create opportunities. Real estate, public market investors tend to throw the baby out with the bathwater. And within real estate, yes, if I own a 20-year leased office building that looks and feels more like a bond, then yeah, maybe I want to be cautious. But if I own rental housing that's got strong fundamentals, or I own last mile logistics, maybe a high growth, higher inflationary, higher rate environment isn't so bad for that asset class. So as markets get nervous about some of these asset classes, that could create opportunity.
Real quick, though, we're in the UK, for example. I just feel like the UK is getting hit on so many different sides at the moment.
Well, near term, obviously, the UK has a lot of supply challenges.
Yeah.
But I think the UK coming out of Brexit will find its footing. We have been the biggest foreign investor there. We really like the rule of law, again, an entrepreneurial culture, open to foreign investment. And I think the UK will continue to be a very important spot in terms of financial markets and investment within Europe, even if it's not part of the EU technically. And it's in a range of sectors. We've been doing it in real estate. We've been doing it across companies. We've been doing it in the travel and leisure space because we think Brits want to get back out. They want to travel. People want to go back there. I'm going to London in a couple of weeks. So I think Europe overall has lagged in its recovery coming out of COVID, certainly the continent, which could create opportunities. And I think people underestimate sort of the strength as we come out of this around the world. And I think it will be positive for growth, but again, challenging on the cost and inflation side.
So on that point, I'd be remiss if I didn't get your take then on the energy crisis that's happening in Europe, a touch here in the US, and then obviously in the UK. UK maybe more logistics, but the idea that as we go into this green energy transition, there's some problems that like maybe weren't really addressed or known. Opportunity or risk?
Both. The good news is we are investing less in hydrocarbons, exploration and production. If you went back to 2014, it's down about 50% globally. So that's really positive. The challenge is for societies, that means we rely on hydrocarbons for 90% of our energy today. And as we bring the supply down, we have to bring on the supply of renewables at the same pace. And we haven't done that. Part of that is technology related, but part of that is our own regulatory framework. You covered a story where we got approval to lay a 340-mile transmission line from Quebec to Queens that will provide enough energy for 1 million homes in New York City, the equivalent of 44% of the cars taking their emissions off the road. But it has taken us 12 years to get selected and approved, and it'll take another 4 or 5 to build. And I think governments around the world have to find a way to accelerate that process. Otherwise, we're going to end up with some acute shortages, and we're beginning to see that. And so that's something we worry about. Now, on the positive side, in our energy equity and energy debt area, we're deploying a lot of capital. We've committed in the last few years $11 billion to things in solar and to wind and water, all sorts of businesses sort of as part of that supply chain. I think that's going to create a lot of opportunities. We just invested in a company called Array Technologies. It moves the solar panels to track the sun. These are very exciting things around energy efficiency. At Stuyvesant Town here in New York, we put solar panels on the largest apartment complex in the United States. So lots of exciting things. But my concern is the pace of that needs to go much faster. Otherwise, consumers are going to feel the pain, and the political will may abate a bit. And so I think what we need to do is, as a society, say, this is important to us. There's clearly capital available to invest, and we've got to facilitate that, make it happen faster.
Yeah, 12 years. That's a long time.
That is a very long time.
We're almost out of time, so I wanted to get your understanding of, like, what's bubbly right now?
Well, there certainly are some technology businesses, some green energy businesses trading on very lofty revenue multiples as opposed to earnings. And when we get sell-offs and concerns about rates, those companies can swing an awful lot. I think the 10-year Treasury at 1.5% and a lot of investment-grade corporate debt that's tied to that, very tight spreads over very low base rates, That to me seems an area where I would be more cautious. I think as investors, you want to be exposed to, you want to be invested in real estate and infrastructure and companies that can grow in this potentially higher rate environment. And so you really want to be cautious about long duration fixed income in our mind.
If 1.5% is still bubbly on the 10-year, like what should it be?
Well, if you went back pre-COVID, the 10-year was 2% and inflation was 2%. We had 0% real rates. Today, inflation's running over 5%. Now, some of that may be transitory, certainly, but 10 years, 1.5%. So that spread is almost 4 today. I feel like that could narrow. Now, inflation may come down as we get through some of these bottlenecks, but I think it's going to be higher. We've got 35% more money supply in the major markets around the world. So I think the likelihood of more persistent inflation continuing, even at a lower rate than today, I think that likelihood is very high. And so the 10-year feels like it should be higher. And so you want to be mindful of that. It will impact almost every asset class. There are some that'll do better. Insurance companies that'll be able to reinvest at higher rates should do better. But I think you want to be mindful of this as an investor.
Almost at time. Brilliant. You're counting yourself down. Thanks, John. I really appreciate it. It was so great. Having you in person makes the world of difference. Thank you so much.
Thank you, Alex.
All right. And thank you all for being here. Invest Global continues now with a conversation about investing in innovation. To access that, please turn to your main agenda. We hope you stay with us.
Okay, you've been listening to Alex talking to Jonathan Gray, Blackstone President and CEO. This is part of day one. It's just day one of the Bloomberg Invest Global. You can continue to watch it on your terminal. All you've got to do is go to Live Go, or you can find it on the Bloomberg website. This is Bloomberg.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So Tuesday the 5th, a little under half an hour to go until the European markets shut up shop. What do you need to know out of Europe? Well, energy prices surging to fresh record highs. I look at my screen. UK nat gas is up by 20% today. And traders are warning that there could be more still to come. Boris Johnson says that the UK does not face an economic crisis. Interesting to hear what Mr. Gray had to say about the UK just a moment ago, telling business to pay workers more to deal with the rising cost of living. We'll update you on that story as we work our way through the closing portions of the Conservative Party conference. And EU leaders, well, they're about to sit down to a dinner, the focus of which is going to be the EU's approach to China. That should be a really fascinating conversation. It's really going to set the stall of where Europe sits between the US and China. We're also watching what is happening in the Senate. Elizabeth Warren is going to be speaking in a few minutes' time. We'll bring you her comments live because it could have an impact on where we see the Fed transition in terms of leadership going next. We'll come to that in just a moment. But first, let's check on where we are with the markets. Equities on both sides of the Atlantic generally well bid. We're kind of reversing the narrative that we saw over the last couple of days. But the real standout story is what is happening right here. That number isn't a year-to-date gain. That number is not a 6-month gain. That's not a 3-month gain. That is a today gain. UK nat gas futures are up by 20% on the day. It is absolutely spectacular what is happening. We've heard from trader after trader talking about the fact that there could be potentially still more room to run here in terms of how high gas prices could go. Could come basically down to what kind of a winter we're going to have. So that's the situation here over in Europe. Let's figure out what's happening stateside. Abigail Doolittle, over to you.
Well, Guy, those natural gas gains for the UK gas, that's really pretty extraordinary. It tells you there's still a lot of liquidity in the system seeking a home, whether or not. As for what's happening here in the U.S., we're looking at the best day for the S&P 500 going back to July. The S&P 500 at session highs up 1.4%, a very strong ISM services, better than expected, suggesting that U.S. consumers still have confidence and that the economy is chugging along. And you can see that big tech, the FANG index, the NYSE FANG index, your Apples, your Amazons, your Facebooks, doing very, very well. In fact, its best day since August, up 2.4%. This despite the fact that yields are higher. You can see that 10-year yield has backed up 5 basis points. Now, that supports the risk on tone because folks don't want bonds. But it's interesting. Yesterday, you had the tech wreck when the 10-year yield was at 148, 153. Traders are okay with it. Now, one piece not fitting the risk on picture here. It's always interesting to look at what does not fit if there is that piece. And today it's copper down 0.9%, hugging that 200-day moving average. Perhaps a sign that the volatility, the up and the down that we've had recently, Guy, it may just continue.
Abigail, we'll continue to cover what is happening. There's a lot going on. We're going to hear from Elizabeth Warren very shortly. We've obviously got the Facebook story unfolding as well. All of that is going to be folded into the markets. The Fed is firmly in focus, I can tell you, not only because of what Elizabeth Warren potentially is about to say. As we've been hearing, the Bloomberg Invest conference is on. I had the pleasure a few minutes ago to speak to Luke Ellis, Man Group, of course, the world's largest listed hedge fund, talking about a whole range of things, including the story around bonds, but just getting his take on where these markets are right now.
If inflation scares the central banks into actually raising rates in the near term, that would be a problem. But otherwise, personally, I think we're getting a bit of a shudder here, and then we will start another march quietly upwards, not at the rate we saw for the last 12 months, but if we've got reasonable growth, equities, they are in the end, Tina, they're the only alternative for most people.
Sharon Bell, Goldman Sachs, Senior European Equity Strategist, joining us now. Sharon, great to have you joining the conversation. Do you agree with Luke?
I completely agree with the Tina point. Your yields on bonds are kind of guaranteed negative in real terms, unless you get a deflationary narrative. And, given what you're talking about today with gas prices, that seems very unlikely. So equities still provide you that real return, and they provide you some protection against inflation.
OK, let's talk about this, because that's what everybody's trying to figure out right now. Is Europe a better place to be in this environment? Europe looks like it doesn't necessarily have some of the inflationary impulses that are hitting the UK and the United States. Does that make Europe easier to park money in?
Yeah, look, I think these inflationary impulses are global, really. So Europe is also seeing tight supply, tight labour markets in some cases, seeing gas prices go up, etc. So I do think the sort of inflationary impulse is global. But, European equities are quite interesting because they have quite large weights in sectors that often gain from a little bit more inflation. So commodity sectors, banks, financials, etc., if it means that rates start going up. So those types of sectors will do quite well, whereas Europe has lower weights in tech or some of the really long duration, high growth areas that tend to suffer when interest rates rise.
I'm back, by the way. Guy, thanks for holding down the fort. Nice to see you. Haven't seen you all morning now. So on that point, so we both had different experiences talking to different types of investors, Sharon, but I was talking to John Gray, and he still likes the UK, for example. Even though they may have some short-term problems, they like the rule of law there, they like the opportunities. What do you do with UK assets now? And you still have sterling dropping like a stone, high inflation, and potential rate hikes.
Yeah, so, there's lots of headwinds for the UK. I completely agree in the near term. Look, I maybe take a step back as well. One of the reasons for this higher inflation is because the recovery has been pretty good, both in the UK and the rest of Europe. You've recovered back up more or less to your pre-pandemic levels of GDP. Demand is very, very strong, and it's hitting sort of these supply bottlenecks. Now, I do think some of them will be more persistent than a few months. But we've just seen the end of the furlough schemes in the UK. That sort of will release potentially a bit more labour supply, may ease some areas. And I think I also agree with the comments about property rights, rule of law, a government that's very keen on investment as well. And we have a fiscal event at the end of October, which again, I think the government will be looking to emphasise research and development, more investment, sort of bringing up productivity growth.
OK, but let's talk about the UK, therefore, in a bit more detail, because, and I want to take us back to the conversation I had with Luke Ellis. His concern is that central banks do react to this inflationary story, that they do tighten into it. There is a danger in the UK that we're tightening into weakness, i.e. the economic momentum fades, but because of the inflation narrative, the bank is forced to act. That's a fairly toxic combination.
Yeah, I agree. So look, we think that the Bank of England will raise rates in the first half of next year, be one of the first key central banks to do so. We're looking for them to start raising in May, but to do so pretty slowly, get up to 1% by the end of 2023. So very cautious in the light of these sort of higher inflationary measures that are coming through, but also in the light of the pickup in demand. I mean, there is a risk that they go earlier than that, even by the end of this year. And I think that would be tightening into a period where we still don't have the information about the labour market post the end of furlough. So I think it would be sensible to wait for that.
In terms of the potential for longer term opportunities there, and then I guess also in Europe, you mentioned banks. And I wonder where the biggest opportunity in banks is going to be, as now kind of everyone's allowed to raise their payout. How do we know what the differentiator is going to be?
Yeah, you mean sort of actually start paying dividends? Yeah. Yeah, I mean, that would be great for European banks, because look, European banks are not fast growth. I mean, they're very low growth as a sector. So really, what do you get when you invest in banks? What do you want to have? You want your cash sort of returned to you a reasonable yield. So that dividends is really, really important. I guess by forcing them to cut their dividends, it's improved capital. And the banks have actually performed pretty well this year. I think partly because of economic recoveries, and partly because capital positions have been good, and partly because they are now going to be able to start paying dividends. And the dividend yield on the bank sector in Europe and the UK is extremely good. 5-6% dividend yields. As I say, you're not going to get a huge amount of growth, but that is a very, very good sort of comparative yield, particularly, again, going back to comparisons with other asset classes. The other thing with banks is they probably will like a little bit higher interest rates. I mean, this has been a problem for them in recent years. They've had no margins. Rates.
Sharon, why wouldn't you own US banks? It looks like we're going to get higher rates in the United States. It looks like, as you just said, we're going to get higher rates in the UK. Why would you own European banks when it looks like rates are going to remain on the floor? The ECB looks like the least likely of the major central banks to be hiking.
Yeah, so I think UK banks are quite interesting. I mean, obviously, they form quite a big part of the pan-European banking universe. And I do think they're getting a bit more interesting, as long as UK growth is okay. And because of better growth, not just because of slightly higher inflation, the Bank of England starts raising rates sort of towards the end or middle of next year. I think that would be really good for the UK banks. The mortgage market should be reasonably healthy as well, with the strength of the housing market too. So we do quite like some of the domestic UK banks. And then comparisons with the US banks are obviously a bit more expensive. We also think the Fed, I know the market is now sort of expecting the Fed to raise rates quite early, maybe into next year. We think that they'll wait until 2023. Yeah. So our view would be it's going to be a bit longer.
Sharon, we have to leave it there, but I really appreciate you sticking with us, and I was happy I was able to make it back to talk to you. Sharon Bell of Goldman Sachs. I want to take you now to the Senate floor. Senator Elizabeth Warren is speaking. She's expected to address claims of Fed corruption.
These officials have access to private information, often gathered at the expense and even by legislative mandate. There is no room for self-dealing by federal officials. There is no room for even the appearance of self-dealing. Every member of the Federal Reserve should know that without a reminder from Congress. But evidently, there is a problem at the Fed. We don't know the scope of the problem or how long it has been going on, but a very disturbing picture is emerging. Last month, it was discovered that during the economic turmoil of 2020, as the Fed was called on to take extraordinary measures to support our economy, Robert Kaplan, president of the Federal Reserve Bank of Dallas, made multiple million-dollar-plus stock trades. It was also disclosed that in the same period, Eric Rosengren, president of the Federal Reserve Bank of Boston, made multiple purchases and sales relating to his stakes in real estate investment trusts and other securities. A new report last week revealed that a third key Fed official, Vice Chair Richard Clarida, also traded between $1 million and $5 million out of a bond fund into stock funds exactly one day before Fed Chair Powell publicly suggested possible policy actions that would significantly affect bonds and stocks. The Federal Reserve makes hugely consequential decisions involving interest rates, trillions of dollars worth of lending and debt, and the regulation and supervision of the banking and financial systems. 2020 was a particularly consequential year, with the Fed taking unprecedented steps to backstop financial markets in response to the pandemic. To make these specific decisions, Fed officials needed access to vast quantities of proprietary, non-public data and information about individual firms, the state of the economy, and upcoming Fed actions. Under these circumstances, for Fed officials to actively trade in the market raises legitimate questions about conflicts of interest and insider trading. These Fed officials' actions show, at a minimum, very bad judgment. They also suggest that some Fed officials believe that building up their own personal wealth is more important than strengthening the American people's confidence in the Fed. In his years as chair of the Fed, it is not clear why Mr. Powell did not take steps to prevent these activities. Surely he understands that this kind of behavior by Fed officials corrodes the public trust in the Fed, and that in turn, such corrosion undermines the effectiveness of the Fed. Surely he understands that the Fed officials' trades run afoul of agency guidelines, which state that officials should, quote, avoid any dealings or other conduct that might convey even an appearance of conflict between their personal interests, the interests of the Federal Reserve System, and the public interest, end quote. Surely he knows that according to the Fed's policies, its officials, quote, have a special responsibility for maintaining the integrity, dignity, and reputation of the system. Accordingly, they should scrupulously avoid conduct that might in any way tend to embarrass the system, end quote. Surely he is aware that the Fed's policies instruct officials to, quote, carefully adhere to the spirit as well as the letter of the rules of ethical conduct, end quote, and to, quote, exemplify in their own conduct the high standards set forth in those rules, end quote. As the sitting chair of the Federal Reserve, the responsibility to safeguard the integrity of the Federal Reserve rests squarely with him. Setting the right culture at the Fed and making sure safeguards are in place to prevent self-dealing and to protect the public's confidence should be the minimum standard any Federal Reserve chair should meet. And once there is a problem, a quick and aggressive response is critical. Chair Powell has failed at both tasks. Last week, I said that I would not support Chair Powell's renomination because in one decision after another, he has consistently failed to serve as an effective financial regulator. But that is not his only failure. Chair Powell has also failed as a leader. Our nation needs leaders who are willing to set aside and enforce strong ethics standards and who act swiftly when a problem arises. Our nation does not need a go-along to get-along leader who doesn't know or doesn't care when, on his watch, people with great responsibility advance their own interests over the interests of our nation, or someone who drags his feet in dealing with problems that shake the public's confidence in the institution he leads. We need changes at the Fed. I have already called on key Fed officials to voluntarily abide by stricter ethics standards. Yesterday, I asked the SEC to investigate these trades to determine whether these Fed officials may have broken laws on insider trading. And I will continue to push Chair Powell to vigorously enforce the ethics standards that already exist and to put stronger ethics standards in place at the Fed. In the last Congress, I introduced sweeping ethics legislation, the Anti-Corruption and Public Integrity Act. This legislation would ban all individual stock ownership by members of Congress, by cabinet secretaries, by senior congressional staff, by federal judges, by White House staff, and by other agency officials while in office. It would prohibit all government officials from holding or trading stock if its value might be influenced by their agency, their department, or their actions. And it would require senior government officials and White House staff to divest from privately owned assets that could present conflicts of interest. This far-reaching legislation would also tighten conflict of interest and recusal requirements and shut the revolving door between industry and government. Now look, this proposal won't solve every problem. And for any officials who have engaged in illegal insider trading, we don't need a new law to hold them accountable. But this proposal would dramatically reduce the possibility for any appearance of impropriety at the Fed and at every other federal agency and in Congress and in the White House. I urge Congress to pass this legislation and to restore Americans' trust in our elected leaders and the officials who make key decisions. Key decisions not only about the economy, but about public health, the environment, and every other aspect of government. There's a lot of housekeeping we need to do, and the faster we start, the faster we get it done. Thank you, Mr. President. I yield the floor.
Okay, you've been listening to Massachusetts Senator Elizabeth Warren on the Senate floor, very much addressing the issue of Fed corruption. Alex, she started this conversation a few days back, calling Fed Chair Jay Powell a dangerous man. She's followed it up with this speech talking about wider changes being required, not only at the Fed, but more broadly across government agencies. It's going to be interesting because this comes clearly at a time when everybody is focusing on the Fed, figuring out what role it will play, particularly as we deal with the debt ceiling debate. Elizabeth Warren is throwing some extra grit into the machine here. It's going to be interesting to see which way Biden jumps.
I mean, it's no surprise that she's coming after Powell so hard on this. I mean, specifically, Powell has failed as a leader. And as you mentioned sort of last week when she came out and said, I'm not going to be endorsing you. I think you're a dangerous man. And this really does feel in some ways mounting another attack on Fed Chair Jay Powell. Now, even if we were to get a different Fed chief, who like a Brainerd, for example, Lyle Brainerd, who may be dovish, I think that there will be some kind of recalibration in the market as that leader then proves themselves, what their rhetoric is, like how they deliver their press conferences. And that is always a little bit of a jumpy time, I think, for a market.
Well, it's uncertainty, it's change. We don't know what ultimately it will lead to, and as a result of which the market will have to discount that. I think, as you say, I think the emphasis will be more in terms of the change falling on the regulatory side, but nevertheless, monetary policy could be critical, certainly over the next few months. We're dealing with an inflationary surge. How does the Fed deal with that? How is the current kind of communication going to change? All of that, obviously hugely important for the market. But it's interesting as well. I think you just need to sort of fold what is happening here and what Elizabeth Warren is doing, because she's pushing at something that obviously is part of a wider narrative, and that is that you have this huge tussle within the Democrats between the more moderates towards the center, those that are further to the left. Maybe the further to the left don't get what they want in terms of the spending numbers. Maybe one way of dealing with that would be to deliver change at the Fed. I don't know. It seems like a
Absolutely, which also then raises the question of, I thought that, monetary and fiscal policy were supposed to be separate, not sort of Fed officials being horse traded to get some kind of infrastructure bill through. So I do wonder what that through line is. But to your point, the progressives aren't going to get what they want, right? I mean, it really feels like it's about what Manchin and Sinema, the senators who are holding up the human infrastructure bills, what they want, not the other way around. So let's get some more perspective into how all of this feeds into each other. Wendy Benjaminson, Bloomberg's deputy managing editor of the U.S. government, joins us now. Wendy, what was your take on what we heard from Elizabeth Warren?
Well, this is the continuation of Elizabeth Warren's sort of battle right now against Chairman Powell. She doesn't want him to be renominated to the chairmanship, which President Biden is considering during this season. She's clearly taken this trading scandal as, the rung she can really hang on to push for serious changes at the Fed and hopefully convince the president not to reappoint him. I mean, that's what she
Is this a separate issue to what is happening more broadly with the spending plan debate, with the debt ceiling debate? Is this separate? Can I compartmentalize this? Or is there a link back to what is happening there?
No, I think this is a separate issue. The debt ceiling right now is sort of, as you well know, all tied up in partisan politics and whether the Republicans will allow the Democrats to vote alone or whether some of them will soften. And the infrastructure plan, as well as Biden's economic agenda, that's sort of all over here. Senator Warren today is focusing on Chairman Powell and this trading scandal and what she believes is the need for stricter oversight of the Fed.
But you don't think that they're related, that there won't be any horse trading going on because of that?
You mean horse trading about Chairman Powell's future and the debt ceiling?
The progressives get one thing when it comes to the Fed, and then they don't get something else they might have wanted in infrastructure.
Well, it depends on the timing. Right now, the White House is saying they're not really focusing on the Fed chairman thing. Fed chairman search. I do think that the progressive Democrats are certainly feeling their oats right now. They've won a delay in the infrastructure vote. They are pushing for more and more and more, as you were just talking about. And so I think they are certainly feeling, the power that they have now to work the White House over.
Wendy, we're going to leave it there. Great analysis. Thank you very much indeed for jumping in and giving it to us. Wendy Benjaminson, thank you very much indeed. Bloomberg is going to be speaking to Elizabeth Warren. That conversation, 4:30 p.m. Eastern time today on Bloomberg Television and Radio with Bloomberg's David Weston. This is Bloomberg.
Impact China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
So we're wrapping up regular trading here in Europe. The day about to come to a close, and it's a positive session that we're looking at, as you can see on the screen behind me. Most of Europe bright green. The CAC 40 in Paris up by 1.5%. The DAX up by over 1%. The UK, yesterday's outperformer, relative outperformer, today up by 0.9%, a full 1%. But basically a bounce back. The thing that's worth noting here as well is that this is being delivered on fairly decent volume. So the volume on the upside, the buying, the dip mentality seems to be fairly good. So that's something that's worth taking away and bearing in mind when you see maybe the market coming back and turning things around. I know we can talk about dead cats and all that sort of stuff, but nevertheless, it has been a fairly significant sell-off over the last few days. Let's take a look at the session. You can see what's been happening here. Europe kind of clawing its way higher throughout most of the day. Wasn't really until we got traction in the States that I think that the rally really took off. And you can see that within the last couple of hours as the US market opened and then a push higher, up by around 1.2% for the broader stock 600. I want to show you a few other asset classes because these are worth bearing in mind right now. The first one I want to show you is UK nat gas. So UK natural gas, the price has gone up by 20% today. This isn't a one-year story. This isn't a one-month story. This isn't a one-week story. Today, UK gas prices have gone up by 20%, as you can see, and we're off our highs. That's the other thing that's worth bearing in mind. You read the trader comments. We all get ping loads of notes here about what is happening in the energy market. The sense seems to be that there is potentially more to come here. So the short-term inflationary narrative is certainly represented there. But you're also seeing it in the broader energy markets as well. We saw it yesterday in Brent. The push beyond 80 has continued. We're trading on the Brent crude contract up at 82, 88, nearly 83. We're up by another 2% today. The pound, though, actually bouncing back a little bit today. We're getting a bit of dollar weakness. It's reasonably broad, but we are seeing a little bit of a bounce back in the pound. Boris Johnson certainly trying to maybe emphasise the positive rather than the negative in what he's been saying about the UK economy. He doesn't certainly see the shortages as a negative. He sees it as a transition to new sunlit up plans for the British economy. But John Gray backing him up. We were talking to the Blackstone boss just a few minutes ago, the COO talking about the fact that they like the UK. They see it as having good rule of law. All of those kinds of factors coming into play. The pound bouncing today. Let's talk about what we're seeing in terms of the sector breakdown story. Let's focus there. Banks up, yields higher, banks benefiting. But technology bouncing back today, TMT doing reasonably well, technology, media. The energy sector, though, continuing to surge. Just about every sector in positive territory except for travel and leisure. Let's talk about some of the single stock names and focus on what has been happening there. We're getting updates in terms of what we're seeing in terms of sales from a number of different companies. Greg's out with a trading update today. You don't know what Greg's is? It's Cornish pasties, cups of tea, donuts, that kind of stuff. Big expansion plan, and they're pushing ahead and they're hoping to accelerate that plan. The market really liked what it heard today. Greg's up by 10.51% today. The trading update from Infineon actually quite positive as well. It's got battered yesterday on the tech sell-off. Today bouncing back again. The update fairly positive. And I think this one here is worth finishing on as well. If you take a journey down the A303 here in the UK, you go past Wincanton. Wincanton is one of the largest trucking companies here in the UK. Again, had a trading update today, Alex. We've got a shortage of truckers. The fear was that as a result of which you'd see wage inflation. You'd see inflation eating away at the margin of this business. But actually, they held their outlook fairly steady. The market took that as a huge positive. Wincanton up by 7.5%.
Well, talking about that, Guy, just in terms of wages and inputs, et cetera, supply chain issues are the talk among all the CEOs that have come on Bloomberg Television headed into the holiday season, and some warning that these issues are actually here to stay for a much longer time.
I can't find an empty container. Empty containers are a problem.
We have people that have over 100 containers sitting at various ports and factories because they either can't get a vessel due to scarcity.
We need to speed the velocity throughout the domestic supply chain as well.
In the international markets, you're looking at least through February, March, before anything will change. And personally, I think it will go long after that.
What the big chip makers are saying is that the constraints will be with us also throughout the year of 2022.
I wouldn't be cancelling Christmas just yet. Christmas is definitely happening this year. It just may be happening in a different way across the supply chain.
I think that domestically, we're going to have ups and downs for the next year.
So there you have it. Like, we'll have Christmas, but how much are you going to pay for Christmas, I feel, is the question. And when do you start Christmas shopping?
Oh, we've already started. That is already well underway. My wife has kept a firm eye on what is happening with the global logistics story.
And by you, and by we.
And delivered.
When by we, we mean her.
Yeah.
She has the list.
Yeah. Well, no, I was involved in the process to a certain degree. But a lot of companies are bringing forward their timescale because they're worried about what is happening. So in order to meet that all-important series of events around the holidays, they needed to have started early, and that seems to be what's happened. So you front-loaded a lot of this stuff. It's going to be interesting, therefore, to see what happens at the beginning of next year. Mm-hmm. Do we start to see, post the holidays, things starting to ease off? There's clearly a shortage. You've only got to look at the number of container ships parked outside Long Beach or LA or wherever it is to appreciate that there is a huge crunch right now. Does that start to ease? Well, let's find out. Joining me now on set, we're very grateful he's made his way through our testing procedure, is the International Chamber of Shipping Secretary General, Guy Platten. Nice to see you. Nice to have a fellow Guy on set.
Yeah, thank you. Thank you, Guy.
Let's talk about what is happening here. Is this a short-term crunch? A lot of people are talking about this being transitory inflation that we're seeing in the supply chains. Is it?
I think there's some more systemic problems. We've been saying for over a year now, transport workers, just take transport, they've been treated appallingly during the pandemic. So we've got a shortage of sailors now, we've got a shortage of truck drivers, and we're not making a particularly attractive career. So there's real issues in manning the ships, real issues in manning the trucks. I can't see this problem solving itself in just a few weeks or even months. It'll go on for some time yet before we can get supply and demand equalled out. We are taking steps to address it, but there's a way to run on this yet.
What steps do you take to address it, Guy?
Well, firstly is getting governments to take some political leadership, particularly on the transport crisis, in prioritising transport workers so they can cross international borders. We've had awful problems in being able to do that, changing out our crews. At one point last year, we had over 400,000 well beyond their times on board. We've got truck drivers, 14 days sometimes that international borders can't cross. So if governments can work with us with detailed protocols, actually ease those congestion problems, that will make an enormous difference, a very short-term difference, which will really have positive effects on the supply chain. We then too need to make our careers for transport workers an attractive one for young people to come into, so we can long-term make sure we have these vital workers are rewarded and are accorded the right level of respect to keep those vital supply chains going. And we've just seen the effects of what happens when there is schisms in the supply chain and the delays and the shortages in the shops as a result.
So we need to invest in people. Do we need to invest in more kit as well?
Well, the ship owners are already doing that. We're investing. We're purchasing new vessels. Of course, we've got the decarbonisation as well. That causes some uncertainty as well. But ships take, 2-3 years to build, so you can't just instantly create more supply. So it's trying to be investing in digitalisation to make the ports more efficient. So there's a whole range of things which are ongoing now. But ultimately as well, it's all about people, and we need to get the people in there, manning the ships, manning the trucks, manning the aircraft to keep the supply chains running.
So, Guy, where do the people come from? Like, do you get them from other industries? Are they new people entering the workforce? Do they have to come more from the immigration side?
So if you talk about say, shipping, because that's my area of expertise, Many of our sailors and seafarers come from what we call the labour supply countries, like the Philippines, like Indonesia, Russia, Ukraine, some from Europe as well. So that's where we draw our supply. And of course, over the pandemic, we've had real difficulties to get them out of their country, and also difficulty repatriating back to their countries. So we tend to draw a lot of our labour from those countries as well, but also from locally as well. So it's making it an attractive career for young people, because ultimately, if young people see a career where you're going to go away and not know when you're going to come home, or you're treating quite badly, that hardly makes it an attractive one.
One of the things we're trying to figure out at the moment is kind of what the picture looks like for companies that rely on the industry that you represent. Do you think as they look at their supply chains that they will significantly alter the way that they manage them? Do you think they will shorten them? Do you think they'll hold more inventory? What is the net result of this more longer term?
Clearly, our company's going to look at the whole supply chain. I think what it has exposed the fragility of the just-in-time model. So I think there will be some changes coming down the tracks in terms of how the supply chain is structured. But actually, shipping is resilient. The supply chain is resilient. We now need to invest in it and to make sure that we can get over these problems we experience at the moment and get back to that seamless transiting of goods across the world. 14 trillion a year travel by sea.
Well, but I wonder if that actually takes longer than we think, and that you were talking about inventories, right? So if we have no longer a just-in-time inventory situation, that just means we're going to be shipping stuff a little bit more, and the bottlenecks will be a little bit longer, and the orders will go on a little bit longer. What does that mean then for the industry, say, in 2022, early 2023?
I think we're going to see these problems going to well into 2022, but I think towards the middle and the end of next year, things will start, I hope, to become more normalised now, and that's, I think, what we're banking on as an industry. You know, we are investing in new technology, new ships, we are investing in people to try and get over these supply chain issues that we're experiencing at the moment. So there will be an end to it, but I'm not quite sure when to call that end.
One of the things that we've seen happening, and I spend a lot of time talking to airline CEOs, is that belly cargo disappeared almost completely as airlines weren't able to fly around the world, as a result of which they focused on the ships, so they moved from one to the other. As airlines start flying again, how much do you think will go back the other way? I'm wondering if that is a shift that will stick, kind of how the supply chain story is going to work as we go back to a more normal environment with airlines flying, belly cargo there, sort of more immediate stuff there, and then that trickles down and kind of works its way through the rest of the industry.
So shipping tends to have the high volume, it goes by ship. It's the high value tends to go by air. And, you know, of course, when airline routes were cut, I think about 45% of air cargo goes by scheduled flights with passengers as well. So it's hoping as those stuff reinstated, we'll see a return to more normal levels of air cargo as well. But air cargo is whilst it's high in value in terms of volume, majority of it does go by ship. So yes, there has been some shift to ships, but that really hasn't been the cause of the problems.
I'm looking for marginal benefits in terms of trying to seeing things improving.
Yeah, but they will improve with that. Yeah.
Guy, last question for me here. So the other guy already touched on this in terms of greening the ships, etc. And I wonder if you could help me understand the end user demand, like your customers. How much more are they willing to pay to get stuff greenly with zero emissions?
And that's the million-dollar question. We'll see how that play out. Remember, shipping is a highly efficient means of moving mass volumes of cargo across the water. So even if there's an increase in shipping rates, that doesn't necessarily transmit to huge increases in the cost of individual items. You know, you have a container full of 20,000 Nike trainers, for example. If that goes up by even double the price of that shipping container, it's going to have a marginal effect on that individual pair of shoes. So we have to have some context behind it. But undoubtedly, the shift to decarbonisation, the use of green fuels, which are going to be much more expensive than the current fossil fuels, is going to cause problems, and there will be knock-on effects to the end consumer.
Inflation, inflation, inflation. I'm pretty sure that Alex just made up a word there, greenly. I'm not sure that actually
It's what I do, man. It's what I do.
I know it's what you do. I'm just trying to make sure that everybody else knows it's what you do. Making up words. Guy, great to see you. Thank you very much indeed for stopping by. We really appreciate it. Guy Platten, the International Chamber of Shipping Secretary General. Greatly appreciated. OK, what do we need to do now? We need to take a look at exactly where European stocks have settled on the day. Positive volumes today driving markets back higher. The FTSE 100, a little bit of a fade at the end, but still up by around 1%. The DAX up by just over 1%. The CAC 40 outperforming, Alex, up by 1.5%.
All right, coming up, we are going to go back to the Facebook hearing. You're looking at a live shot right now. The stock is up 1.6%, but after a brutal, awful day yesterday where it sat on some moving averages, we'll break down what to learn. This is Bloomberg.
I do believe that, or I'm aware that Facebook is doing
Essa população é uma população importante, é uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando essa transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. A dose foi toda administrada.
What have we learned from this evergreen crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the evergreen is hurting the sentiment, and people don't want to buy. And other developer because they want to get cash.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In London, this is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Singapore's sovereign wealth fund, GIC, may make portfolio changes in response to China's wide-ranging regulatory curbs. It would favour sectors supported by Beijing. The fund's CEO was interviewed at the Bloomberg Invest Global Conference. Lim acknowledged that the changes could mean lower returns in China. It was the worst September for auto sales in the UK going back to 1998. The shortage of computer chips devastated factory output. Car makers sold 214,000 vehicles last month. That's 35% less than a year ago. Meanwhile, September was the best ever for electric vehicle sales in the UK. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right. Thank you so much, Ritika. So we have the former Facebook product manager is now testifying before the Senate today about the whistleblower internal Facebook investigation. So we want to get more on where we sit. We have Facebook shares are up by about 1%. Anna Egerton joins us now. What have we learned so far in this? It's been interesting to hear what Frances Haugen, the whistleblower, says Congress should do about the problems that she revealed in a trove of internal documents that she took when she left Facebook. Now, she said when it comes to trying to make sure that these platforms have responsible content that they share with users, it's not about the initial posting of user content. Companies should be held responsible for the way that content is disseminated. Now, these are the algorithms that companies use to spread content across the internet. And she said that Congress has a role in making sure that those algorithms are used responsibly and are more transparent with users.
All right, Anna, thanks so much for the update. Bloomberg's Anna Egerton joins us here on set for more of the stock reaction, what it means for Facebook's business. Mandeep Singh, senior technology analyst for Bloomberg Intelligence. In order for this to have teeth, though, laws have to be changed. What could materially impact Facebook?
Well, one is data sharing between their apps, right? So they own the three most popular apps in the app stores, both iOS and Android. And it's really, when you look at what they can do with Facebook, Instagram, and WhatsApp, they know a lot about the users and they are sharing the data. So one of the regulatory kind of aspects of this is, are they allowed to share data between these apps? And I think that is definitely getting a lot of scrutiny right now.
So, Mandeep, which areas, is it 230 that we could be changing? Is it the child protection laws that we could be changing? I'm just wondering, you talk about that data sharing, kind of ultimately what is required to force the company to do what it needs to do, and whether or not one piece of legislation can do that.
I don't know about which way the regulatory framework is going to evolve, and it's very hard to guess, but I know for a fact that they're not spending much on content policy. And one of the things that as a shareholder you want to see Facebook doing is to spend more on content policy. Right now, their EBITDA margins are over 50%. So for a company, of this size and scale, they can afford to spend money on policing the content. And they're not doing that. They're trying to do everything algorithmically. And maybe that's not the solution to everything that they can do.
The other part of this is shareholder push, right? What is the will of shareholders to push Facebook on these issues? When the idea is if they put profits over people, but if you're a shareholder, like that works for you, kind of, do they push on this?
Well, so yes, with increasing focus on ESG and governance being one of the most important aspects, going forward, you may see shareholders asking them to be responsible for the content, even if nothing changes on Section 230. You can expect shareholders to make a bigger push on that, yes.
Is Facebook going to fall foul of ESG? Is that ultimately where we're going here? Because at the moment, a lot of these tech companies make up significant proportions of the ESG portfolios. And if we're starting to focus maybe on different letters, i.e. less on the E and more on the S, maybe things change. That is a huge index effect that we could see as a result of this.
Well, so clearly, the focus on the kids and, people under the age group of 20 that are using these platforms, I think there is an increasing drive to look at how these platforms are being used by the younger demographic, the teenagers. And I think that's part of, the ESG initiatives that all these companies are undertaking. So we know there's a big push towards sustainability, but I think you're going to see more towards governance going forward.
Senator Markey talking about the idea that there's going to be more to come, that there is going to be an impact as a result of all of this. Mandeep, thank you very much indeed. Mandeep Singh of Bloomberg Intelligence, thank you very much indeed. You can follow, there's a top live TLIV on your Bloomberg that's following events in Washington that are germane to Facebook. If you want to check that out, that would be great. Up next, we'll take a look at what's happening with the US markets. This is Bloomberg.
you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
We have no exposure to Evergrande, is the short answer. Our own strategy on China for the last several years has been built on building independent credit decisions and credit underwriting.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
All right, stocks rebounding today. Maybe I have to capitulate here to turn around Tuesday. Treasury sliding here. Yields really picking up. Here's some movers with Bloomberg's Abigail Doolittle. Hey, Abigail.
Hey, Alex. Well, it really is a risk-on day, and some of the top point boosts to the S&P 500 today. Your big tech movers, Microsoft, Apple, Nvidia, Netflix, the stocks that were all sliding yesterday, they are bouncing back. But if we go into the Bloomberg terminal and take a look at the IMAP, this is more to show you what's not working. You can see pretty much everything is working, led by the financials and tech. But utilities and real estate, those dividend-rich stocks, not doing as well right now with yields higher, the competition of yields. So it's interesting that rising yields not hurting tech, but hurting those dividend-rich sectors. And then finally, to round it out, we have the cyclical sectors really on fire as well. JP Morgan Chase and Schwab both sharply higher. One reason the financials are leading. And then oil's up about 2%, Guy. You can see that some of the big energy names going along as well. And Albemarle, that chemical and paint company, it is also climbing, helping to explain why the material sector is doing well. Net, risk on, and very constructive.
Yeah.